Dear Shrestha viewers, welcome. Today we are going to see the topic called comparison between types of long-term sources of capital. In the last class, we were discussing about the different types of sources of capital that is required by a joint stock company. Now we are just seeing a half part of it, that is called long-term sources of capital. We have many types in that, right? As we studied that long-term is divided into many types like equity shares, preference shares, debentures, financial institutions, etc. So the same thing we are going to see what is the difference. There are some common points collected together. How does it reflect in each case? We are going to see it today. Before going into this, let's get clear with few terms, that is market value, conversion and residual claim. This might sound something new, so let me explain it first so that you can understand the rest of the part clearly. First, market value. What is market value? I'm just asking you the meaning. So, whenever a company you situate or you started, you will have a value of your company in market, like it is high level, middle level or something. That market or where your share level stands in that place is called the market value. The market value for your company, for a share in your company in the market. Now Reliance is there, its share value in market value, that is called market value. That can be, each share can be of 2000 rupees, 60,000 rupees or even like 10 rupees, 5 rupees also. So like that is called as a market value. Then what is conversion? We already know, we already saw it in the types of features of company, like conversion or transferability of shares. Like we have studied in few companies we can't transfer the shares, that is private company. In public company we can transfer our shares, but in private company we cannot. Here it is called the conversion, means it's talking about the shares, so it cannot be converted in few cases, like if you are coming to equity shares, there is no conversion, whereas other two you can convert it, like that term means that. And then the last one is residual claim. What is residual claim? This word is absolutely new to you, because these two terms are sounding new but you know the meaning. But residual claim is something like you have, once after you pay or clear all your debentures, all your loans, everything, the amount or the right left on the assets of the company, with whom that right will be left at the last, with the owners, right? That is called a residual claim. We have another definition for that. If you know, you just comment and let me know, but I'm just giving you a small meaning. Okay, residual claim is the right on the asset once after you're clearing all your debentures or the loans of the company, the leftover amount or the claim you have on your company is what called as residual claim. Clear with that? Now I hope you are clear with these terms so that you can easily understand what I am going to explain today. So firstly, again, market value. Have we already seen that what is market value? That where the company stands in the market. So if a company, Reliance, is standing at the top position, its share value, like some company, whatever it is, standing at the top position, it means that its share is of good value. If you are buying shares or you are selling shares of that particular company, definitely you are going to be benefited. So that's the thing. So in that case, we'll examine it in three different types of long-term sources of capital. We already know what are the sources of capital: equity shares, preference shares and debentures or loans. Debentures or loans are like we are getting it from some external part, and preference and equity are something like owner's capital kind of stuff. So what is equity shares? What is the case in equity shares? Changes according to time. Obviously, whenever a company has to issue their shares, we can't predict that the shares always remains the same. Once upon a time, the share value was just 10 rupees or 20 rupees. Now it increased to 100, then it might increase to 1000. So it changes according to time. That may be years, 10 years, decades, centuries, whatever it is. So changes according to time. In equity shares, the market value of a share in a company changes according to the time. And if we are seeing to preference shares, no frequent change. So the amount of preference value of shares amount, whatever it is, once you fix that preference shareholders are the people who invest, they are also kind of shareholders, but they don't have any changes. Once you are coming into company with a fixed amount, you will be getting the same thing again and again whenever you come to take your profits. So there is no frequent change, it remains the same. And when coming to this D and L, what is a D and L? Debentures or loans, that is also no frequent changes. So debentures or the loans are the people, they are creditors or people from the financial institutions, as I told you, IDBI, IFCI, commercial banks. I asked many people the short forms, the full forms of those abbreviations, but no one gave, but it's fine. That is debentures and loans. So these are the people who come to collect their loans where we are liable to pay them. So how much it is liable, we only pay that much. Some certain amount like 15,000 interest, we pay the same. Like share value, it doesn't increase. One month it is 15 and another month is some 20,000 or something like that. It doesn't change. So here also there is no frequent changes. So that is called debentures and loans. In this case of equity shares, shares value or the market value of shares change according to time, and the preference shares and debentures and loans doesn't change. It has some fixed amount of capital or amount that you pay. It doesn't change. Then conversion, as I already told you, transferability or that flexibility to transfer your shares, convert your shares. So that is not possible while it is equity, because they are the real owners of the company, and when they want to run the company, they themselves won't go to other company. So that transferability is not at all possible in this. And then conversion is possible. These are the partners who come to invest in public companies, So they are the other partners are coming from outside to invest shares, something to buy shares. So this preference shares will be paid amount, but that doesn't change. In the same way that so that because they don't change and they just take a fixed amount of capital, that conversion is also easy for them. So not only in this company, wherever you may go. So in this company, in my company, you are getting the share value of 15,000 per share. And I'll be paying you the same 15,000 for each share, so that if you are happy with this, you can stay in my company. Or else whenever you get in other company also, you'll get that amount, that fixed amount doesn't change, but it might be more than my company, like some 20,000, or something might be less than my company who are paying 5,000 per share. People who are there in that company, 5,000 per share, they can come to my company, or if they are feeling low that it is really less, 15,000 per share is less, then they can also shift for other company, but it doesn't mean that I will increase my share value for them. The fixed amount, the preference share fixed amount is always fixed, and that doesn't change even if you go to any other company. So it remains the same. If you want to go for higher thing, you can go to other company. Once they fix a value of share value as a 50,000, they only pay you 50,000, not other than that. So like that, then conversion is not possible in equity shares, but in preference shares and debentures or loans is also conversion is possible. What is conversion is possible? Here they are the creditors, right? So the conversion is possible in the sense they are flexible, like once one cannot be, then other can also bear the amount. So like that conversion is also easy. Here it is possible, here it is possible, here it is not possible. And then voting rights, equity shareholders are the real shareholders or the real owners of the company. So they have the voting rights to elect their board of directors. So they can by themselves, they can vote like yes, I want him as chair, some board of directors, a manager, some types of managers, the top level management and all. They have that right to vote and select the members of their company. But preference shareholders and debenture holders or the loan people won't have the voting rights, because they are just a part of a company who lend the money, they take it back. Preference shares, they just come to invest their shares in order to get some profits. Like we invest some amount in the bank so that interest rate increases and we can get our amount back, like FDs and all. The same way we invest in the business so that we get some amount in return that is much more than that bank. So we invest in this so that our share value also increases. If you put it in the bank, few banks won't give much interest, but shares obviously it will increase, at least 1 rupee or 2 rupee also it will increase on the future date. That is the hope. So like so they don't have any change, even they don't have voting rights, they just come to take share profits and go, that's it. So they don't have voting rights. Then maturity, as I told you that maturity date of this equity shares will be permanent always, it doesn't change. But when coming to preference shares and debenture or loans, that maturity value is converted. That preference shares and this debentures and loans will have a maturity period time. If that period crosses, like I already told you about commercial papers also, maybe that is short term fund, but we'll have some maturity value. I'm giving for an example. If that maturity period is done, it will be converted again into equity shares. That equity shares are the real owners who are providing the capital as shares to others, like preference shares and debentures, that the same capital, right? So when they are not taking, what will do? When I'm offering you money and you are not at all coming to take it, what will I do? I'll put it in my account, yes or no? The same that equity shareholders also do. So once a maturity period is done, the amount of this preference shares is converted into equity shares, and the same case with the dividends and loans. That is what called as maturity period. And then residual claim. As I already told you, once after the payments or after clearing all the things that company has to clear, like expenses, this loans and etc. of a company, whatever it is, the leftover asset, the right on that leftover asset or amount, whatever it is, the profits, whatever it is, it comes into the account of the owners. So they will be the residual claimers of the company. They are the only people who have the right. So this residual claim is there in equity shares, but not in preference shares and debenture and loans, because they will obviously get their capital or amount on the end of the month or year, something like that. They are paying them. That's what we say in this residual claim, that once after paying all the things that we are liable to pay, the leftover amount, my salary is 10 lakhs, suppose. After my expenses and that loan which I have to bear is nearly up to 2 lakhs or something. After paying the 2 lakhs, that is 1 lakh for loan and other 1 lakh for expenses, remaining 8 lakhs is my income, that is my asset. So I can invest wherever I want. So I am an equity shareholder, the loans or expenses, whatever it is, that is debentures, and the 1 lakh is something like the preference shares, whomever I have to pay, and the remaining 8 lakhs are my own money, that is I am an equity shareholder. So that is that residual claim, the remaining that 8 lakhs are the residual claim, that is mine. So did you get what is a residual claim? Now what is preference? Preference is nothing but having I prefer you as best, or I prefer you as a managing director, I prefer you, I mean I want you to be in that place. First preference will be given to you. In that means that. So last preference is given to equity shareholders, that is company is mine. Why will I take the first preference? First I'll clear whatever it is there, and the leftover thing, like whatever I said you, like residual claim, the leftover will be mine. but first I won't come, like that preference will not given to me. So preference will be given, not it won't give preference to me. Then to whom? For preference shares and D and L, debentures and loans. You are calling someone to party to your house and you should give preference to them as they are your guest. You treat them, you give something to eat, you make them enjoy everything. But you won't take yourself as a first preference, like I called you for party so you entertain me. No, you will entertain them, right? So in the same way, the preference will be given to the outsiders first, then you will take the next. So preference will not be given to equity shareholders, but the preference shareholders and dividends. So preference over preference shareholders. So shares can be collected also, like this shareholders anyhow they'll get the amount, so they'll stand in a line. But these loans are the thing, if you won't clear it once, it bounces. So shareholders, as you already know, it will be fixed. 15,000 you'll get 15,000 only. So if you don't get 15,000, you won't say that pay me as interest as 2,000 still and I want 17,000 this time. It is not possible, no. But these loans are something like they generate interest and that loan may bounce also. So before that preference shareholders also, the debentures and loans will be given the first preference, and then the preferential value will be given, then next the preference is given to the preference shares, and last to the equity shares in this case. So everything is in the favor of the company only. The company is nothing but equity shareholders are running the company, so the last preference is given to them. And last but not the least, fixed dividends or interest. So in matter of shares we call it dividends, but in matter of interest, this word interest, where we use that when it is something related to banks, interest, deposits, loans, in this kind of terms we use the word interest. So fixed dividends or interest, percentage of dividend dividend changes every year. For equity shareholders, that percentage of dividend, as they are the owners of the company, they work hard for the company, they make many more policies, to get a great amount of profits, the shares value obviously will increase. So you won't say like my co-partners are just taking 50,000, so I will also take 50,000. You just pay them whatever it is every year, however you pay, and remaining whatever it is 60,000 or 70,000, you will take it, right? So that doesn't change, it will change every year, that doesn't remain same. So percentage of dividend changes every year. But in case of preference shares and debenture or loans, fixed rate of dividend, fixed rate of interest. Like fixed rate of dividend in the sense, every year what you get or every month whatever you get the same amount as dividend, either it is 15,000, 20,000, 25,000, whatever it is. And fixed rate of interest, this month or this year you are liable to pay some 50 lakhs. 50 lakhs you just take and just go, that's it, not more than that, that doesn't increase. So whenever you take a home loan, you will have some fixed period of interest, like you have to pay this amount every year so that you can clear your loan. So you will pay, you put a limit, like every year I am going to pay 2 lakhs, 3 lakhs, like that. So when you pay 2 lakhs every year, your amount gradually decreases, your loan amount, and one day the house will be yours. So in the same way, but that doesn't change. Okay, but in equity shares the dividend will be changing every year. So these are the main points: market value, conversion, voting rights, maturity, residual claim, preference, and fixed rate of dividends or interest. These are the points which we have to observe in each case in the matter of equity shares, preference shares, and dividends and loans, to know the difference between those. So we basically studied long term funds and short term funds. Whatever funds are funds, many people might think, but there are difference in that. Owner bearing capital is something like equity shares and preference shares, but when coming to Others, in the other part of long-term capital itself, it is called debentures and loans. Debentures are the debenture holders who give the loans, that is like acknowledgement of debt that is maintained by the company, that in the seal of the company, that we are liable to pay on the future date. But loans are from financial institutions. Okay, so I hope I am clear with these 7 points. Even if I have left anywhere a point or it is not clear to you, you can comment and ask me so that I can clear you in the next session. If you like my video, like, share and subscribe and be the family of Stray Star.